Hello everyone and welcome back to That Investing channel. Today I thought I'd take a different approach and cover 3 top dividend growth stocks that I think are great investments in the UK. Now we all know the state of the UK economy and stock market. It isn't great, but that just means I've got to look harder to find those hidden gems, and I think I've identified a few. One is an amazing consistent grower that gives me a great peace of mind for the future. Another has great brand loyalty and explosive dividend growth over the past 5 years. And finally, the last one is a bit of a dark horse that I think maybe is missed by most investors at the moment. I'll jump into the financials and past performance of these stocks, move through the dividend safety and growth, and finally cover a fair value for the stock and what analysts are expecting in the future of these companies. Now the key point with these companies is to grow that dividend at a higher rate than inflation is growing, which in the UK is 3.4%. Therefore, having a source of passive income that increases at a faster rate than that inflation itself. Now I love these style of companies for the resultant yield on cost for my portfolio, just like Coke stock became for Mr. Warren Buffett. So let's jump in with the first one of these stocks, which has very high operating margins to make it very appealing. Rexel provides information-based analytics and decision tools for professionals and businesses all over the world. It operates through 4 segments: risk, scientific, technical and medical, legal and exhibitions. So in the simplest of ways, they advise businesses and clients on how to improve processes with a focus on science and healthcare. With the high operating margins, high cost for clients to change analytics partners like Rex, this one has a good competitive edge. So it's no surprise it has done very well over the past 5 years in the share price, and investors that had held this stock would be up over 100% if they'd stuck with it. Now the financials of this business is impressive as well. Increases on their top line revenue over the last 3 years of 13%, which shows consistency if a little slow. Even better, on the bottom line, net income increases of 32%, which is promising to see. Cash position is substantial and has increased over the past 3 years, with the debt position ticking downwards. So things look good here. How about the free cash flow? Ticking up in the right direction. Not massive jumps, but shows the consistency of the business we're looking at, reflected in those free cash flows going up steadily. Now, on the more impressive part about this company, the dividend growth. 67 safe rating for that dividend, with a last 5-year growth rate sitting at 7%, which is not double digit, but very strong and probably one of the best that I've seen in the UK. So look at that beautiful graph showing the massive income increases. Dividend growth streak at 13 years, with the payout ratio sitting below 50%. I think we can keep seeing those increases in the high single digits. Now the other parts of this company that impress me is the growing free cash flow per share, which is only 1 down in the year of 2020 over the past 10 years. So that's consistency that is great to see. A reduction in shares outstanding, so buying back those shares at an impressive rate, and return on investor capital trading up and sitting at an impressive 25%, which is fantastic. Operating margins, again, ticking up 29%. This year, over the past years, increasing as well. So we have a company that is growing in every meaningful way and returning value to investors at an impressive rate. Now, the fair value for this one. Morningstar has it fairly valued at 3,650 and it's currently sitting at 3,424. So it may be a good entry point. But this is one I'll be keeping an eye on for the future and maybe look to add if it does dip. Next, we have a lot more established and mature company. However, this one is still growing in its financials and returns a very impressive growing dividend yield. It's Games Workshop, a British manufacturer of miniature war games, most well known of which is Warhammer. Now, at first glance, one could be forgiven for thinking this would be a company dying out in an age of modern gaming. However, the financials and reality tell a different story. This company is the most successful hobby miniature crafter in the world, returning 217% to investors in just share price appreciation in the past 5 years. This company has a high level of brand loyalty, and that means every time a new line, and Codex of Warhammer is released, this stock appreciates. Now that's not all. With the growing euphoria around Henry Cavill starring in a new Warhammer 40k film, this stock could do very well from people rushing to play the game if the film does well at the box office. Now what do the financials say? On the top line, revenue has shown extremely impressive growth. After the last 3 years, up 82%. Similar story on the bottom line, even better, up 92% over the same time period. So that's not exactly a company that's slowing down on the growth to me, or too mature. It's almost doubled its cash in 3 years or so, and has no long-term debt whatsoever. Then we get on to the free cash flow. 13% CAGR for the last 3 years, which is consistent, promising, and which hopefully is reflected in the dividend. Let's find out. Now it's surprising despite this share price appreciation, but this one is actually primarily a dividend payer, with a massive current yield sitting at 4.18%. Now this is due to the massive dividend growth of this particular stock. Now I'm not sure what to say about this graph other than it's very promising. 23% dividend growth CAGR over the past 5 years, and last year's a whopping 121% increase. Now let's make sure there's no nasty surprises with this impressive sort of growth. There's only one concerning point of the growth, with the free cash flow payout ratio sitting at 86%. Now that is any sort of changes or fluctuations with this free cash flow, we could see dividend cuts. However, as we saw from the graph, with the increases it's made, that might not be that bad. Let's check out the other points of this stock. The free cash flow per share increasing steadily, which is great to see. Now they are issuing shares, not buying them back, so that's a little concerning and not preferable. However, to make us feel better about that, the return on investor capital sits an exceptional 62%. Additionally, those operating margins sit above 32% and just seem to be getting better and better each year. So we have an established company with a great and loyal customer base that is growing convincingly and returning that to investors in the form of great dividends, share price appreciation, and return on investor capital. So this one stood the test of time, and I must admit it's very impressive. However, the valuation of this one is looking a bit more on the expensive side, even though analysts expect it to have a 17% average upside from alpha spread in the next 12 months. So it could be that it usually trades at a premium, and it maybe seems to warrant it. And finally, the dark horse of the group, this stock may be overlooked because of its past performance when it comes to share price. Things don't look great over the past 5 years for this one, only returning a measly 6% in share price appreciation with no dividends reinvested. Well, a lot of that has to do with the falling property values over COVID and in this market of high interest. However, with interest rates set to start coming down in maybe the near future, and with house prices increasing in the next couple of years, this one could be set to outperform in 2024. Rightmove plc is the largest online real estate company with a whopping 83% market share of the housing market in the UK. Now this is reflected in the financials of the company itself. Total revenue has increased by about 77% over the past 3 years, whilst net income has nearly doubled in the same time frame, over 90%. They have reduced their overall cash position over the past 3 years, however I will say they have no real debt to consider. Then we move to the free cash flow. Now there is growth, if a little bit slow, and there was a negative year. Whilst this may be bound to be put down to COVID, we have to remember the share price has barely moved. So the free cash flow for the current year sits at nearly 40 million more than it did when the share price was nearly the same 5 years ago. Now let's dive into the dividend growth and see how that's getting on. The yield currently sits at 1.71%, so not as high as the others. However, apart from dividend cuts due to bad cash flow year, this is a good graph with 9% dividend growth last year and a 7% CAGR over the last 5. The payout ratio on the free cash flow looks good, sitting just below that 40%. And we have great other points too. Sales growth looking good too, around 10%, except for that one bad year which could be attributed again to COVID. Now, one of the more impressive things about this company is the great share buybacks. So whilst the share price has barely moved in 5 years, they have bought nearly 100 million shares. This is reflected in the return on invested capital, which is growing, and with such impressive operating margins above 50%, this is definitely one for the watch list. Now, analysts expect this one to get to the highs of maybe 622 in the next 12 months. So it could be this one that's been trading flat for so long is about to change. If you like these stocks and want to see ones that I hold in my Trading 212 portfolio that's over £16,000, then feel free to check out my last update. As always, best of luck with your investing, and I'll see you in the next one.